So yes, you have read the title right. I've broke my rule and I added more Alibaba yesterday during trading hours. So I think for long-time viewers, you'll probably know that I've made some sort of a commitment that I'm not going to add to my Chinese exposure because I already have an outsized position in them. And in fact, I do see quite a lot of deals out there, especially in the US tech space and some of these major US names. So I think just to set the expectations right, this is not going to be a very, very deep dive into Alibaba's most recent earnings. And yes, it's because of Alibaba's earnings. That's why they essentially plummeted down by 8 to 9% yesterday night. So briefly, I'm going to walk you through my thought process on why I bought more Alibaba shares yesterday, and also how I positioned and adjusted my portfolio, and more importantly, what were my main concerns walking into this investment when I added my exposure. So sit tight and strap in. Truth be told, actually yesterday night, I was very, very motivated to make a video immediately when I placed in the buy order, but I was looking at the entire price action. It was extremely volatile and both buyers and sellers are very enthusiastic in getting their orders in. That's why I delayed my video making, and as you can see on the bottom right, it's basically very, very early in Singapore time at 7 a.m. So some of you might ask me, hey Chiking, look, you essentially just dropped 8 grand buying into Alibaba again. I bought a total of 95 shares at an average price of $79.98. So I believe Alibaba actually closed $79.11 yesterday. So let me try to explain myself. So this is essentially the updated portfolio position of my entire portfolio in terms of the percentage exposure and also the gains and losses on it. So this is updated as of 16th of November. Let me bring you back just to 2 weeks back or 1.5 weeks back on the 4th of November. This was my percentage portfolio exposure back then. So do you notice any differences? So this is my 4th of November and this is 16th of November. Yes, there's actually one less counter. As you can see, my KWEB position, it actually vanished. So my fourth largest position became Amazon instead of KWEB here. I sold my KWEB position, used the proceeds and bought into more Alibaba shares. Hey Chiking, are you like crazy or something? KWEB is supposed to be an ETF. It's much more diversified. Why are you undiversifying yourself? I don't even know whether that's a word, but why are you concentrating your position? So for KWEB specifically, it tracks the CSI Overseas China Internet Index, and it's a free float market cap weighted index. And if you look at the top 10 holdings, it is extremely concentrated, with Pinduoduo being the first position at 10%, and then you have your normal Chinese tech names like Alibaba, Tencent, Meituan, NetEase, Baidu, etc, etc. So let me walk you through my thought process on why I sold KWEB to buy into more Alibaba yesterday night. Long story short, I actually started my DCA into KWEB in end of 2021 and I stopped the DCA in end of 2022, if I'm not wrong. So that's why I had a pretty low cost basis on KWEB compared to my Alibaba position. I believe I had an average cost price of around $30. And when I sold KWEB yesterday, it was around 27. So I took the L, or I took the loss. I booked in the loss at around 10%. And that works out to be around $600 plus. So let me tell you why I sold KWEB. I think there are two main reasons. Firstly, it's because the utility of this ETF has changed. And secondly, it's about fees. So what do I mean by the utility of this ETF has changed? So when I initially bought into KWEB, the main primary reason was definitely because of diversification. So I just wanted an exposure that was greater in breadth. That's why you have so many holdings. But truth be told, I was only following the major ones like Pinduoduo, Alibaba, Tencent, Baidu. I wasn't following Full Truck, NetEase, Trip.com, etc. So when I really look at it, when I own an ETF, it's true that you reap the benefits of diversification. But on the flip side, I really don't know what I'm owning. That's the first point. Secondly, I think when I look at how the holdings have changed, initially when I bought into it, Pinduoduo was not at the top. So Pinduoduo actually rose to the top because it had a pretty phenomenal run over the last 1 or 2 years. I think when you compare it across all the other Chinese tech names, Pinduoduo was the best performing one. So this is definitely one of the benefits that you own an ETF. You don't know what you don't know, so you just allow the market to do its thing and to rebalance for you. But that said, I think I've made the assessment that I'm going to own the entire digital tech infrastructure in China today just by owning Alibaba and Tencent. The rest in this case, even though it has managed to cushion the entire impact of the portfolio, but it's not necessarily an interest that I wish to continue pursuing on in terms of buying some of these names that I probably don't even know of. So that's the first point. The utility of the ETF has changed. On the second point, it's really the idea of fees, or some of you might call it the expense ratio is at 0.7%. So in this case, since I've changed my mind on the utility of this ETF, so that's just my general thoughts on why I switched out KWEB into BABA. I've got really good news. So Webull has decided to extend their upsize sign-up campaign for new users until the end of this month, which is the 30th of November 2023. So new users to Webull can now create, fund and maintain any amount in their Webull account for 30 days and win 10 fractional shares worth between 100 to 5,000 US dollars. So if you sign up on your own, you will only get 2 free shares. So remember to sign up with the link down below. So Webull's in-house platform feature has helped me save a lot of time. When looking into a new company, some of you might just want to have a very high level understanding of the basics. So in Webull's native app, you can actually click into the company section and it will essentially provide you with an overview of the company's past financials, key indicators that you can play around with, and even peer comparisons among their competitors. So these numbers and rankings allow me to make the split decision on whether I should look into this company further, and thus it has saved me a lot of time. So the recent Moneybook campaign has also been extended, so both new and existing users can take advantage of this new lowered requirements. You can deposit a minimum accumulated amount of 3,000 US dollars, keep it until the end of the event period, and most importantly, activate Moneybook to enjoy cash rewards ranging from US 100 to 2,000 freaking dollars. So for those without a Webull account today, I don't know what you're waiting for. Sign up with the link below now. Thank you Webull for sponsoring this video. So moving back to BABA, I'm just going to reveal it. Why did I buy 95 shares? It's basically to round up the number. So right now I own 600 ADRs of Alibaba with a cost price of around 110. So technically I think my cost price is closer to 108 or 109. But what I did was essentially did a mental accounting. I booked the losses of KWEB into Alibaba so that it's easier for me to track. I do have my own tracking system on Excel. I think 110, I'm still in a fairly attractive position for Alibaba to outperform, hopefully, in the next coming few years, even though it has underperformed for the past 2 to 3 years already. Moving on, the second biggest factor that I've seen is really the idea of Jack Ma selling out. So this has also caused a lot of jitterness amongst investors last night, and it is confirmed that the Ma Yun Family Trust, which is JC Properties and JSP Investment, plan to reduce their holding of 5 million shares each in Alibaba Group on November 21st, which is next week. So this transaction involves a total stock market value of around $870 million according to the SEC filing. So intuitively, Jack Ma being the face of the company, if he sells out, it spells trouble or bad news for investors, right? Why are you still optimistic, or why are you still buying over the shares? So this is actually not the first time Jack Ma actually reduced his position. So in 2020, he has already reduced his stake by around 1.4%. And this time round, when I wanted to Google how many shares does Jack Ma still own, there isn't really a very accurate or clear answer, but seems like based on the latest report, as of Feb of 2022, Jack Ma still owns around 3.7% of Alibaba. So if you just do a quick tabulation, Alibaba total outstanding shares around 2.5 billion. So if you take 1% of that, that's around 25 million. 10%, 250 million, 100%, 2.5 billion, correct. So 1% is around 25 million shares. So at around a 3.7 to 4% stake, he owns nearly 80 to 90 million shares, if I'm not wrong. Let me do a quick check. 3.7 times 25 million, yes, that's around 92.5 million shares. So out of 92.5 million shares, he's selling 10 million shares. I don't know what is it for, whether is it for his own expenditure, tax planning, family planning, financial planning, whatever you have. It's really none of my concern. So at first glance, it looks bad, but firstly, it's not the first time Jack Ma is selling. Secondly, Jack Ma being an insider, if he really had lost hope in the company, he should have sold out much earlier. And there is a track record that he sold out in 2020, probably before the crash. So he knew something. He only cut his exposure by 1%. He still has around 3 to 4% now. He continues cutting, but that's really not my point. So I'm invested in the company and I'm more focused on how the company is performing. So riding onto this point where Jack Ma's family trust is selling out 870 million worth of Alibaba shares. So to me, this next point actually negates the issue with that $800 million in selling. So in Alibaba's latest disclosure, they said that during the quarter ended 30th September, we repurchased approximately 18.6 million ADS. More importantly, they have $14.6 billion left under the current share buyback program authorized by the board, which is effective through March of 2025. So considering now it's near the end of November 2023, so March of 2025, that's around 5 more quarters. 5 quarters plus 1 month. So 5 times 3, 15 months, plus 1 month, 16 months, considering December. So 16 months, I'm trying to blow through 14.6 billion. That's nearly $1 billion per month. Or at least, if you want to be more accurate, that's around $800 to $900 million per month. So if I'm expecting Jack Ma's family trust to sell 870 million, Alibaba share repurchase program can easily offset this selling pressure because they are net buyers of their own stock. I'm presuming that they are gonna continue executing on this share buyback program. So that's the first point on why I'm not very concerned about this Jack Ma story. And on the second point, which is the new addition where they are gonna flex their financial power and to show everybody that, hey, the cash on my balance sheet is real. That's why they announced a $1 US dollar dividend per ADS. I know that there's some commotion amongst the Alibaba community, specifically the US investors, saying that there's a lot of withholding tax, they should just buy back more shares. But I guess they probably have their own thought process, which is arguable and debatable. I'll talk more about it in the specific video where I'll break down their most recent earnings. So this is considered the positive side of the news. Now, I think just trying to draw your attention to these 2 main concerns that I personally have. I think firstly, it's really the idea of cloud competitiveness. I think many investors came into the investment with the thesis that, hey, Alibaba Cloud is probably the crown jewel of the entire group and it's the next growth curve. And despite that, despite many of the conversations around how Ali Cloud is aggressively cutting price to be much more competitive, this is back in April of 2023, and they said that tech giant Alibaba's cloud computing division will cut prices for its product and services by up to 50%. And even after many of these aggressive price cuts, Alibaba's cloud intelligence group actually came in at around 2% year-on-year growth. So you can see that their cloud competitiveness is really lackluster, and it probably spooked many investors that initially had their investment thesis around Ali Cloud. But at least to me, my main investment thesis is still Alibaba's main business, the e-commerce advertising business. It's going to generate a crazy ton of cash flow for us as investors, and it has proven its worth time and time again. So that's why personally I think the thesis still stay intact. The second main concern is really the idea of internal politics, and there's a clear lack of direction from the management team and the board. I think initially when we were talking about how the previous CEO, which is Daniel Zhang, he first mentioned that he's going to step down and focus on the cloud business. That is back in June of 2023. In a surprise move just 2 months after, Daniel Zhang is going to quit the cloud business entirely and he's going to manage some sort of an investment fund worth $1 billion. You know that something is definitely going on. It's extremely fishy and it's probably quite confusing from an outsider perspective. So the benchmark and standards for a multinational company that is worth more than 200 billion US dollars, I expect the communication to be much more cleaner and leaner. Not so much of this kind of back and forth. I announced something today, 2 months later I announced something else. And on that same note, even for their cloud IPO, in their most recent earnings, they also just announced that they are no longer proceeding with a spin-off of their cloud intelligence group. They cited reasons of US chip export restrictions, etc. So I'm also going to discuss this spin-off in the earnings analysis. So remember to stay subscribed and of course smash that cute little like button for me. But anyhow, if I can sum it all up with an analogy, so Alibaba is basically this huge ship. And it's a very well-built ship. The fundamentals of the business is good. Margins are expanding, earnings are expanding, bottom line is expanding, free cash flow is expanding. But that said, at least over the last 2 years, there was a thunderstorm. And that's why there was some sort of challenge. I'm trying to maneuver this ship. And on a side note, they are currently undergoing some sort of a leadership transition and they have basically replaced the captain. So the new captain probably needs some time to regain command and control. So this is the bottom line. I'm buying a fundamentally strong ship. I'm expecting the captain to wake up his idea soon. And I do see the thunderstorm slowly subsiding. With that, I'll see you in the next video. But more importantly, I'll finally see you on the moon. Goodbye.